Ladies and gentlemen, welcome back to the channel. In today's episode, I'm going to tell you why I think next year Tesla is going to have a massive year and why this market is going to have a really good year next year. Now, we're going to talk about the near term as well between now and the start of 2026, what I believe is going to happen and why you could see some pretty dramatic upside as well. Now, there's some risks for next year, and we'll talk about those in this video. Also, there's going to be things that happen that are unforecasted, like Liberation Day of 2025. Everyone was expecting tariffs, but nothing like we've seen on Liberation Day. Even Tom Lee said yesterday, we will probably get a policy shock at some point next year that will be bad for markets like we had in 2025. I don't know if that's going to happen. You can't predict those things with any kind of reasonable degree of certainty, but there is one risk that makes me a little nervous for next year that might happen towards the end of the year. So I want to share the good and the bad with you and my expectations, okay? And really why I'm bullish on next year and why I'm especially bullish on Tesla stock. Like Tesla could be a $900 to $1,000 stock next year. My opinion, not a financial advisor, not a financial planner. Obviously, come to your own conclusions. But these are my thoughts. Do me a quick favor, hit that like button as well as subscribe to the channel. Check that link out down below in the description of today's episode if you have not done so already. If you guys want to come join the trading community where, in my opinion, we're basically stealing these hyper-growth AI stocks right now as Wall Street has been nervous about everything, honestly. And I think there's a lot of opportunity in the stocks that we are investing in. But again, I'm not a financial advisor. Come to your own conclusions and do your own research. Now, let's get started here with my opinions on the short term. Now, you guys have heard from Tom Lee in the past 24 hours or so. Tom Lee says we're going to have a massive rally into the end of this year. Okay? That's likely true. He says that Bitcoin could hit new all-time highs by the end of this year. He says the S&P is going to go up 5% from here with about an 80% certainty on that. So some very bullish remarks. There's two things that are going to happen between now and year end that drive this market higher. Number one, in the very near term, between now and December 10th, we don't have any real risk catalyst, okay? We don't have earnings. We don't have really any economic data. We're going to have initial jobless claims, one or two of those between now and December 10th. But that's really it. What do we know thus far? We know Nvidia just had really good earnings. We know Walmart had really good earnings. We know that the economy is doing okay, not great. We know that we're going to get a Fed rate cut on December 10th. So based on the information that we have right now, you would think we have a very positive setup at least until December 10th and really December 16th. December 10th is the Fed meeting. We're going to get a rate cut, and the Fed's basically going to say they're data dependent. Okay, we kind of already know what the Fed's going to say, but you might start to see the markets care less about what the Fed says because we're going to be getting a new Fed chair, a new Jerome Powell in May of 2026. So how much does it really matter what Powell says? It doesn't, okay? And if we're looking towards 2026, the markets might just look through any negative comments that Powell says, okay? We'll see. Obviously, that is TBD, to be determined, but that would be my thought. So really over the next 2-ish weeks, you don't have much that could hurt this market. Given that, you likely do see a rally into December 10th. Now, December 16th is the big day. That's when we're going to be getting your jobs reports and some of your CPI reports and some of the data that we've missed during the government shutdown. following December 16th, as long as it doesn't look like the economy is so good that we don't need a rate cut anytime soon, or so bad that the Fed has to panic to cut rates that we're heading into a recession, that likely is a recipe to give you a further rally into the end of this year. So that's part one. Part two is the chase. And I've talked about this before. It's pretty straightforward. It's pretty simple. When Wall Street, 80% of hedge funds and institutions underperform the S&P, they tend to chase into year end. They want to narrow that gap, okay? They want to take on a little bit more risk and outperform the markets in the last couple of weeks of the year. After all, they've already done their tax loss harvesting, and really just chasing and getting the return up to the S&P is almost something you have to do if you're one of the 80% of hedge funds and institutions that underperform the S&P, because it looks really bad if you underperform the S&P, if you're trying to win over new clients, right? So a chase is likely, especially since so many stocks are so far off of their all-time highs. Your AI stocks, your hyper-growth stocks, small caps, even some of your larger cap tech, Meta, Tesla, Oracle, right? Down 10 to 40% still from recent highs that we were at a month or two ago. So you're likely to get a chase, okay? But then there's some people that are going to be positioning for 2026. Because right now, beyond just the short term, the next 2 to 4 week kind of tactical trade, which heavily favors the upside, all of what we've talked about is the quote-unquote tactical trade. There's not a lot of fundamentals based in chasing and the fact that we don't really have any event catalyst over the next 2 weeks or so. That's tactical. Fundamental, Wall Street is looking at 2026 and saying, hey, what areas, what stocks are likely to do well? And what do I think is going to happen to the markets next year? Now, we've heard from a lot of your major banks so far, JP Morgan, Morgan Stanley, Bank of America. Bank of America had a little bit more of a tepid outlook on the low side, saying the S&P could be 5,500 on the low side, which today the S&P is like 6,800, so that would be quite a bit of downside. In a more worst case scenario, they say in a best case scenario, you're looking at the S&P around 8,500. Most firms are at about 8,000 for the S&P, which is about 800 for the S&P, which is pretty good upside. Not too shabby, to say the very least. If the S&P gets to 800 next year, from current levels, that would be upside of about 17%. A lot of Wall Street thinks we're going to have kind of this year-end Santa Claus rally. Historically, as Tom Lee has argued, you should rally about 5% from now into the end of this year. So maybe that's a 12% return next year from where we end this year, okay? Still, nonetheless, pretty good upside. But why? Well, I have put together my thoughts and the catalyst for next year, and I want to break them down. Number one, AI is alive and well. This is important. AI is the biggest revolution since the internet. At some point, there will be a problem, and we'll talk about this. It could happen next year, but this is the one thing that I'm nervous about, okay, that we don't really talk about much on YouTube. Nobody really talks about this much, okay? But it is a very real potential negative catalyst next year. But generally speaking, AI is alive and well. I expect that it will continue to be alive and well next year, okay? But I do think we probably start to see a shift, okay? Some of the nuclear companies and some of the quantum companies, I'm not super bullish on those next year. Why? Because I think Wall Street, they're in a put up or shut up kind of phase, right? If you're a company like, what was it, D-Wave Quantum or Rigetti, right? They're like, it's going to take 3 to 5 years to have this quantum computer and to actually like generate revenue from it. I don't think Wall Street just wants to sit around and wait 3 to 5 years on something that may work or may not work, okay? A lot of nuclear companies are going to take 5+ years to actually come to market with, revenue and generating, energy capabilities for companies. okay, that are using AI. I don't know if those are the areas you want to be in next year. So you do want to be choosy in the companies you're investing in. You want companies that are actually using AI today and bringing in revenue today. Even if they're not profitable, preferably you want a company that will be profitable at some point next year or early 2027, right? Because by mid 2026, people are going to be looking ahead towards 2027 and they're going to say, okay, this company's going to be profitable, right? You don't want a company that's not going to be profitable until 2030. So a little discerning could go a long way next year. But generally, AI is alive and well, and you're going to see more and more applications and use cases come along with AI. Number 2, earnings are strong with upside likely. This is always the case, okay? But right now, earnings are strong, and you're likely to see upside to that. Now, how much upside to that we'll see? Some of your major banks like Morgan Stanley and even Bank of America are projecting 12 to 15% earnings growth next year. Even Bank of America, that says, on the low side, the S&P could actually fall next year, is expecting 14% EPS growth for the S&P. Okay. Earnings is what ultimately moves markets, and then you have the multiple on top of that. I don't really see multiple contraction with what we're going to talk about in the next bullet points. But pretty basic, earnings are strong with upside likely. That supports stocks. Consumer strengthening with big beautiful bill and real estate. Something a lot of people don't talk about is real estate. If we do get the Fed starting to buy treasuries, if we do get inflation that comes down, as my expectation is next year, all of these things, mortgage rates are going to come down. People are going to be able to sell and buy homes again. Okay? Take it like this. If you bought a home in 2020, $200,000 home, let's say, your mortgage payment, call it $1,000 today, $1,200 today. If you want to buy that same $200,000 home today, the mortgage payment's going to be over $2,000 a month. Even if you're up $100,000 in equity on that home, you don't necessarily want to sell that home and buy a new home and double your mortgage payment, even if you're going to take $100,000 to the bank, right? That's the mindset. Even though on paper that makes a lot of sense to do that, a lot of people don't. Okay, so real estate is a big one. If you can get mortgage rates and affordability that starts to get better, you're going to see a situation where there's a lot of equity that's going to hit people's bank accounts as they sell their homes. That is an upside supporting catalyst for this economy. Now, consumer strengthening with a big beautiful bill. No tax on tips, no tax on overtime. Okay, some of the tax changes like being able to write off auto loan interest and all of that. Those things kick in mid-2026. You actually get the no tax on tips, no tax on overtime benefits on your tax return. So it's something that Wall Street has almost long forgot about at this point, but will come back around mid-year, and you will see the consumer strengthen to some degree. Okay, so those two things are important. Fed rate cuts. Now, this has to do kind of with inflation, in my opinion. If the economy is good, it really depends on inflation. Now, bullet point 8 here is, I think inflation is going to continue to come down. I think it takes a long time for inflation on paper to come down, although inflation has long been dead, right? We really don't have an inflation problem anymore in this country, but the way it's calculated, it takes a long time for inflation to come down, mainly because of owner's equivalent rents, things like that. But next year could be the moment where you do start to see inflation come down in a material way. Services has started to, slow down a lot. And that's where a lot of the alpha typically is in the inflation report. Usually goods are negative. Like goods prices tend to come down. Like that TV, that 50-inch TV you bought 10 years ago is cheaper today than it was before, right? It's cheaper today than it was 10 years ago. Goods tend to go down and services tend to go up a lot over time. Well, you've seen service inflation start to come down as real estate begins to, level off in the inflation data. You're going to see inflation come down quite a bit next year. That is going to fuel Fed rate cuts. We get a new Fed chair, which is point number 7 here in May, And I think they're going to be heavily leaning towards supporting this economy, whether it's through like QE, like transitioning the balance sheet to treasuries, which they've talked about a lot, which would lower the 10-year treasury yield. Again, the Fed with rate cuts only really moves the short end of the curve. But if the Fed begins buying treasuries, they can start to get the long end of the curve, like the 10-year treasury yield, which determines mortgage rates and things like that, to actually come lower. And that could help spur all of what we're talking about here. So Fed rate cuts, how many do we get? Really depends on how much inflation comes down, in my opinion, because I'm not expecting some kind of big economic disaster next year. Okay, and you don't want that if you're invested in stocks. Now, number 6 here, we're going to get clarity on trade. We're going to get the Supreme Court ruling, and hopefully by Q1, Q2 of 2026, the trade situation looks more certain, and that's going to be great for this market. Now, cutting red tape, that's going to take some time, but I do think by mid to late 2026, you might start to see some of the faster permitting, some of the red tape being cut, actually helping this economy. Okay, so these are the key points that I would point to next year to why I think this market's going to do very well. Long story short, strengthening consumer, decent economy, inflation that comes down, allowing the Fed to cut rates, new Fed chair, clarity on trade. That's great. AI is alive and well. That is great. Okay. Those would be the key points. Now, there's smaller things you could probably point to, and this list could probably be a lot longer, okay? But that's my thought. I don't really see the argument of recession or, AI slowing down or any of the bearish arguments as logical, okay? I just don't see it. Now, there is a big risk next year, and this goes from now until whenever it happens. The big number one risk next year is China surpasses the US in AI capabilities, like DeepSeek, okay? If you have a true like DeepSeek moment again next year, that's going to be an issue. Not just in the sense of, oh, okay, large language model is a little bit better than the US. But if Wall Street starts to believe the US is going to lose the AI race to China, that is a massive problem. That is a gray swan event. Okay, it's a gray swan event because I'm telling you this up front, but if it happens next year, it would be really bad. Now, the flip side to that would be you probably get more AI investment, you probably get, the government even incentivizing things, better policy around AI, etc. But that could be an issue second half of 2026, okay? And then the other risk is that AI CapEx slows down. I don't think this would happen unless the economy looks to be on shaky footing. Unless it looks like we're getting closer to a recession and Wall Street's like, okay, Meta, like they start punishing stocks for investing in AI, that's where companies would probably start to scale back a little bit. I don't think that's going to happen, even if the stocks were to get punished for it, because these companies are literally fighting for their survival. Google is fighting for their survival, literally right now. Amazon, they're all fighting to keep their markets and to acquire these new markets. Okay, you think Oracle, Microsoft, Google, any of these guys can stop investing in chips and AI data centers when Nebius, CoreWeave, and the smaller guys are coming to eat their lunch? No, they can't. Okay, they simply cannot. So, but that is a risk if that were to happen. Okay, now there's always the risk the economy unexpectedly weakens or something like that. But based on the big beautiful bill and real estate picking up and all of these things, unless we have some kind of like major bankruptcy or shock event, I don't see the economy like weakening next year. I think next year the economy is going to be a lot stronger than people think. I do think next year one of the best areas will be the hyper growth AI stocks that are executing. Again, you don't want a story stock for next year. You want an executor, okay? Those are the areas that we are investing in. Not companies that are promising things 2, 3, 5 years from now, but companies that are doing the thing right now. Okay, the companies that are projecting to grow 500% next year, bringing in hundreds of millions of dollars in revenue, trading at less than $1 billion market cap, those are the companies that I'm interested in. Not the, nuclear company that's trading at a $5 billion market cap that says they're going to have XYZ amount of power in 5 years. Okay, so you want to be a little discerning, but the hyper growth AI companies, I think those are going to be the biggest winners, especially if we do have a better liquidity market. If we do get the treasury that starts buying more treasury bonds and lowering the long end of the curve, which, is stimulative, okay? As long as we get inflation that continues to come down and, AI is alive and well, this is going to be the area, in my opinion, that really outperforms. Now, for Tesla stock specifically, Tesla is going to have quite a few catalysts between now and the end of this year. Robotaxis should be entering new markets in December, as Elon and the executive team said on the earnings call. That's great. But next year, you're going to see rapid deployments of robotaxis. You're going to see robotaxis in dozens of cities next year. You're going to see Optimus by the end of this year gearing up for larger production, maybe the end of next year, maybe 2027. These are multi-trillion-dollar industries. As Melius Research recently said, Tesla is a must-own. And if you're a Wall Street guy and you've been underweight Tesla for a while, now Elon's compensation package is here, Robotaxi is here, Optimus on the near-term horizon, you're looking at Tesla and saying, yeah, I probably want to own Tesla here. Okay, so I think Tesla does well into the end of this year, is a $500+ stock. But if the stock executes well and we do have a good year in the markets next year and Robotaxi is, doing thousands of paid rides a day, Optimus is coming with contracts by the end of the year, Tesla could be a $900 to $1,000 stock next year. Fairly easily. Dan Ives says in the next 12 months, Tesla could be an $800 stock. But if Tesla executes better than, Wall Street is currently expecting, which would be my opinion, Elon is full foot on the pedal right now. No brake, full gas, full pedal, okay, towards AI and autonomy at Tesla. $900, $1,000 plus, easily in the cards here, okay? And that's what I'm positioned for. Now, we'll see. Anything can happen, okay? But this is my expectation for Tesla stock into the end of this year and next year. And of course, there's going to be speed bumps along the way. There's going to be delivery numbers. There could be slow times or fast times. There could be other issues with trade or shock events. But I think we're in for very strong next year. Let me know your thoughts on this down below in the comment section. Ladies and gentlemen, hit the like button as well as subscribe to the channel if you have not done so already. Have a great rest of your day, and I will see you in the next one.